Imagine your savings, the money you've worked tirelessly to accumulate, being used as a lifeline for governments around the world. This is not just a hypothetical situation, it's happening right now. The global financial system has quietly shifted to a stage where your savings are effectively underwriting government survival. This isn't just about taxes or national debt. It's about how the very structure of financial markets and savings mechanisms are intricately linked to government operations. A bold conclusion, yes, but one that is grounded in the realities of modern economic systems. Consider this. As of 2023, the combined government debt of the world's largest economies has reached a staggering $38 trillion. That's a figure so immense it's almost incomprehensible, yet it directly ties into the savings of millions worldwide. This colossal debt is not just a number on a balance sheet, it represents an ongoing reliance on personal savings and investments, as these debts are often financed by government bonds, purchased by pension funds, banks, and individual investors. The stakes are high, affecting not just national economies but also the financial futures of everyday people. Who are the main players in this complex financial dance? Quite simply, everyone with savings or investments is involved. This includes working professionals saving for retirement, families setting aside money for education, and small business owners looking to reinvest profits. The vast pool of savings indirectly supports government borrowing, as these funds are often invested in government bonds. As a result, the financial health of millions is intricately linked to the stability and policies of national governments. It's a web of interdependence that few truly understand, yet it impacts daily financial decisions and long-term plans. This is not an isolated event. It is part of a recurring financial cycle involving government debt, personal savings, and economic policy shifts, leading toward a complex financial interdependence that shapes our world. To truly grasp the enormity of the situation, we must consider the scale of government debt. In the United States alone, national debt has surpassed $31 trillion, a figure that has been growing steadily, driven by fiscal policies and economic necessities. This debt is mirrored in many other major economies, creating a global tapestry of financial obligations. These obligations are not just numbers, they are promises to pay, backed by the financial health and creditworthiness of nations. When governments issue bonds, they are essentially borrowing from the future, leveraging the savings of today to fund current operations. Geographically, the concentration of debt and savings across different regions reveals significant bottlenecks. Developed nations like the United States, Japan, and European Union countries hold the majority of global debt. Meanwhile, emerging markets often find themselves at the mercy of these economic giants, relying heavily on foreign investment and aid. This creates a financial dependency that can lead to instability. For instance, any policy shifts or economic downturns in these developed countries can ripple across borders, affecting international trade and economic growth elsewhere. Key institutions such as central banks, international monetary organizations, and financial markets play crucial roles in this financial ecosystem. Central banks, for instance, manage national monetary policies and interest rates, directly influencing borrowing costs and savings rates. Institutions like the International Monetary Fund, IMF, and World Bank provide financial assistance and policy advice, helping stabilize economies in distress. Meanwhile, financial markets facilitate the trading of government bonds, which are pivotal in financing public debt. These institutions collectively shape the global financial landscape, impacting everything from inflation rates to currency valuations. The movement of capital across borders, often referred to as capital flows, is a critical component of the global economy. These flows are driven by investment opportunities and economic conditions, with money moving in search of higher returns or safer havens. Capital flows can influence currency values, impact national economies, and shape global financial stability. For instance, when a country experiences economic instability, capital may flow out, weakening its currency and exacerbating financial challenges. Conversely, stable economies attract foreign investment, bolstering their financial positions. This dynamic interplay of capital flows affects government policies and individual financial security alike. To understand how we arrived at this point, we need to trace back to key milestones in financial history. One pivotal year was 2008, marked by the global financial crisis. This event, triggered by the collapse of major financial institutions, led to unprecedented government bailouts and a reevaluation of regulatory frameworks. Immediate financial consequences included massive job losses, a spike in foreclosures, and a dramatic shift in monetary policy as central banks around the world slashed interest rates to stimulate economic recovery. This crisis laid the groundwork for the current reliance on savings and investments to fund government debt. The next significant milestone came in 2020 with the onset of the COVID-19 pandemic. This global health crisis prompted unprecedented fiscal stimulus measures as governments sought to mitigate economic fallout. Trillions of dollars were injected into economies worldwide to support businesses, protect jobs, and stabilize markets. These measures resulted in increased borrowing and debt levels, further intertwining government financial health with individual savings and investments. The pandemic highlighted vulnerabilities in global supply chains and accelerated shifts towards digital economies, altering the landscape of financial interdependence. In 2008, the world faced a financial crisis that led to a seismic shift in how governments managed liquidity. Central banks around the globe initiated unprecedented quantitative easing programs, pumping trillions into the financial system to stabilize faltering economies. These programs aim to lower interest rates and encourage lending by increasing the money supply. However, the magnitude of these interventions also meant that governments accrued significant debt, using the increased liquidity to fund stimulus packages and bailouts. This event marked a pivotal moment where the relationship between government financing and individual savings began to intertwine more intricately. Citizens' deposits in banks became a key source of funds that banks used to purchase government bonds, indirectly linking personal savings to governmental fiscal policies. By 2010, the Eurozone was grappling with its own sovereign debt crisis, notably affecting countries like Greece, Portugal, and Spain. The crisis highlighted the vulnerability of interconnected economies and the risks associated with excessive government borrowing. To prevent a collapse, the European Central Bank and International Monetary Fund intervened with bailout packages conditioned on strict austerity measures. These measures significantly impacted public services and unemployment rates, creating widespread public discontent. This period underscored the delicate balance between government debt management and economic stability, where public savings often became entangled with efforts to stabilize national economies. The crisis served as a reminder of how governments might lean on citizens' savings indirectly through national economic policies to navigate fiscal challenges. In 2016, the Brexit referendum was a pivotal moment for global financial markets. The decision by the UK to leave the European Union sent shockwaves through economies, affecting currency valuations, investment flows, and trade agreements. The immediate aftermath saw the British pound plummet, creating uncertainty in markets and impacting the purchasing power of residents. Investors worldwide had to reassess their portfolios, often opting for safe haven assets. For individuals, this translated into increased costs for imported goods and services, affecting household budgets. The Brexit vote exemplified how geopolitical events can quickly translate into financial uncertainties that ripple through personal savings and household financial stability, demonstrating the interconnectedness of political decisions and economic outcomes. The year 2020 introduced a global pandemic that reshaped economies worldwide. Governments launched massive fiscal responses, including stimulus checks and enhanced unemployment benefits to mitigate the economic downturn. These measures were financed through increased borrowing, leading to a surge in national debts. Central banks slashed interest rates to near zero, making borrowing cheaper but also diminishing returns on savings. For individuals, this environment created a paradox. Low borrowing costs encouraged spending and investment, yet the low interest rates offered little incentive to save. Additionally, the influx of government spending increased money supply, contributing to inflationary pressures that eroded purchasing power. This pivotal event emphasized the dual role of savings as both a personal financial buffer and a tool for government fiscal strategies. Interest rates are a fundamental tool used by central banks to regulate economic activity. They influence the cost of borrowing and the return on savings, thereby affecting consumer spending and business investments. When interest rates are low, borrowing becomes cheaper, encouraging individuals and companies to take loans for consumption or expansion. However, this also means that the returns on savings are reduced, discouraging individuals from saving. For example, during the pandemic, central banks reduced interest rates drastically. This led to an increase in consumer spending as people found it affordable to borrow, but it also meant that savers received minimal returns on their deposits. This dynamic impacts household decisions about spending, saving, and investing, directly linking individual financial choices to broader economic policies. Inflation reflects the rate at which the general level of prices for goods and services rises, eroding purchasing power. Central banks aim to control inflation by adjusting interest rates and monetary policies. When inflation rises, the cost of living increases, affecting household budgets. For example, if wages do not keep pace with inflation, individuals find their purchasing power diminished, meaning they can buy less with the same amount of money. In recent years, inflation has been a concern for many economies. The prolonged low-interest environment coupled with increased government spending can exacerbate inflationary pressures. This scenario illustrates the delicate balance of managing inflation to ensure it remains within a manageable range, safeguarding the economy while protecting individual financial stability. Capital flows refer to the movement of money for investment, trade, or business production across borders. These flows are crucial for economic growth, enabling countries to access foreign capital to finance development projects. However, they can also introduce volatility. Rapid inflows can lead to currency appreciation, affecting exports by making them more expensive. Conversely, sudden outflows can lead to currency depreciation and financial instability. For individuals, these dynamics can influence the cost of imported goods and impact savings and investments, especially those denominated in foreign currencies. Understanding capital flows is essential for grasping how global financial interactions affect domestic economies and personal financial stability. Cross-market links refer to the interconnectedness between different financial markets, such as stocks, bonds, commodities, and foreign exchange. These links mean that a change in one market can quickly ripple through others. For example, a rise in interest rates can lead to a decline in bond prices, which in turn may impact stock markets if investors shift their portfolios. Similarly, a surge in commodity prices can affect inflation rates and currency values. For individuals, these cross-market dynamics can influence investment returns and affect financial planning. Understanding these links helps individuals make informed decisions about diversifying their portfolios and managing risks in a complex financial landscape. The interplay of these financial mechanisms, interest rates, inflation, capital flows, and cross-market links, directly impacts households. Low interest rates may reduce savings returns, while inflation erodes purchasing power. Capital flows can affect the availability of goods and prices, and cross-market links can influence investment returns. Together, they form a complex network that individuals need to navigate to safeguard their financial well-being. For instance, during inflationary periods, individuals may face increased living costs while their savings yield minimal returns. Understanding these impacts allows households to adjust their financial strategies, such as diversifying investments or prioritizing debt reduction, to maintain financial stability amidst changing economic conditions. So far, we've explored how key financial events and mechanisms are intricately linked to household finances. From the impact of low interest rates reducing savings returns to inflation, eroding purchasing power, these elements play a significant role in our daily financial decisions. Capital flows and cross-market links further illustrate how interconnected the global economy is, affecting everything from investment returns to the cost of living. Understanding these dynamics is crucial for making informed personal finance decisions. Next, we'll delve into historical comparisons to see how past financial cycles inform current trends, helping us anticipate potential future scenarios. As we navigate the complexities of how individual savings are intricately linked to government survival, it becomes essential to understand the historical patterns that have shaped our current financial landscape. In the next segments, we'll delve into past precedents that mirror today's situation. By examining historical economic crises and government responses, we can uncover patterns and lessons that may foretell future outcomes. Understanding these patterns can help us predict the impacts on inflation, interest rates, and personal savings. Stay with us as we explore two historical scenarios that bear striking similarities to our current economic environment. By examining these, we can better grasp the potential trajectories and prepare for what's to come. This is not just about looking back, it's about using the past to illuminate the path forward. Let's journey back to the early 1970s, a time of significant economic upheaval. The collapse of the Bretton Woods system in 1971 marked the end of the gold standard, leading to floating exchange rates and significant inflationary pressures. Governments worldwide faced mounting fiscal challenges, and the reliance on public debt increased dramatically. This era saw interest rates skyrocket as central banks struggled to control inflation, directly impacting personal savings and borrowing costs. The U.S. could, for example, experience stagflation, with high unemployment and inflation eroding household purchasing power. This period teaches us about the delicate balance between monetary policy and economic stability, highlighting how governmental financial strategies can significantly impact individual financial health. By examining the 1970s, we gain insight into the recurring themes of economic cycles and the potential repercussions of unchecked fiscal policies. Fast forward to the late 2000s, specifically the 2008 financial crisis. Triggered by the collapse of major financial institutions, this crisis was rooted in excessive risk-taking in the housing market and financial derivatives. Governments around the world responded with unprecedented bailouts and monetary easing to stabilize their economies. The crisis led to a global recession, with unemployment rates soaring and consumer confidence plummeting. Central banks slashed interest rates to near zero levels to stimulate growth, significantly affecting savers who saw their returns diminish. The 2008 crisis underscores the interconnectedness of global financial systems and the ripple effects that policy decisions in one country can have worldwide. By examining this period, we can understand the implications of systemic risk and the importance of prudent financial regulation as a safeguard for personal savings and economic stability. Looking ahead, we can envision three potential scenarios for the future economic landscape. In the best-case scenario, global economies stabilize through coordinated international policies, leading to controlled inflation, moderate interest rates, and a steady return to economic growth. Household savings would see improved returns, fostering better financial security. In a base-case scenario, economies experience slow recovery with persistent inflationary pressures. Interest rates could rise gradually, impacting borrowing costs, but savings might recover slowly. Lastly, in the worst-case scenario, economies face prolonged stagnation or recession, with high inflation and volatile interest rates severely impacting household savings and purchasing power. Each scenario presents unique challenges and opportunities, emphasizing the need for adaptive financial planning and awareness of economic indicators. While these scenarios are speculative, they highlight the importance of being prepared for various economic outcomes. While our analysis presents certain scenarios and historical parallels, it is crucial to consider alternative perspectives. Some argue that governments have more tools at their disposal today than in the past, such as advanced data analytics and more flexible monetary policies, which could buffer against severe economic downturns. Others believe that the global interconnectedness of economies means that any severe economic disturbance in one major economy could lead to a rapid global response, mitigating prolonged negative impacts. Additionally, technological advancements may drive new economic growth areas, offsetting traditional financial constraints. These arguments highlight the dynamic nature of economic systems and the potential for innovative solutions to emerge. However, it's essential to remain vigilant and informed, as even the most robust systems can face unexpected challenges. By considering these counterarguments, we gain a more balanced view of the economic landscape. Understanding the macroeconomic environment is crucial, but it's equally important to translate this knowledge into personal financial strategies. First, focus on building a diversified investment portfolio that can withstand market fluctuations. This means considering a mix of assets such as stocks, bonds, and possibly real estate, depending on your risk tolerance. Second, establish a solid emergency fund to provide a financial cushion against unforeseen expenses or income disruptions. Aim for 3 to 6 months' worth of living expenses. Finally, stay informed about economic indicators that can affect interest rates and inflation, such as CPI reports and central bank announcements. By keeping an eye on these indicators, you can make more informed decisions about saving, borrowing, and investing. Being proactive in these areas will enhance your financial resilience in uncertain times. As we circle back to our starting point, the $38 trillion secret reveals how deeply personal finances are intertwined with government survival strategies. The core lesson here is the importance of understanding the broader economic cycles and their direct impact on our daily lives. First, recognize the significance of historical patterns and their influence on current financial systems. Second, be aware of potential future scenarios and how they might affect your financial strategies. Lastly, maintain a balanced approach by considering counterarguments and being open to adapting your financial plans. By staying informed and proactive, you can better navigate the complexities of today's financial landscape. Remember, knowledge is power, and being prepared is your best defense against uncertainty. Thank you for joining us on this journey through the intricate web of how personal savings fuel government survival. We hope you found this exploration insightful and empowering. If you enjoyed this video, please subscribe to our channel for more in-depth analyses and discussions on personal finance and the economy. Don't forget to like this video and share your thoughts in the comments below. We love hearing from you. Stay tuned for our next video, where we'll dive deeper into how digital currencies are reshaping the global financial system. Until then, keep informed, stay prepared, and remember that understanding is the key to financial resilience.